Ever feel like your paycheck just isn't enough, no matter how hard you work? What if you could earn $5,000 every month without ever clocking in again? In fact, what if you could reach that goal quickly and not wait 30 years to achieve it? There are countless strategies already discussed online, but in dividend investment, there are two key strategies that can make or break your return. In fact, if you use both, it will supercharge your portfolio. In this video, I will show you the quickest way to achieve financial freedom through dividends. I'll break down what dividends are, how they work, and why they're a powerful tool for building passive income. You might be wondering, is this really possible for me? Don't worry, I'll answer that and more. While dividend investing is not a get-rich-quick scheme, I'll show you how you can make it work faster with the right strategies. In the end, I will show you a portfolio of stocks that, when combined with these strategies, can cut the 30-year time frame by almost half and help you reach the $5,000 monthly dividend income goal. Alright, now that we've set the stage, let's dive into the basics. First up, what exactly are dividends? Dividends are payments a corporation makes to its shareholders, usually derived from profits. Think of it as a reward for investing in the company. When you own a dividend-paying stock, you receive a portion of the company's earnings on a regular basis, typically quarterly. This can be in the form of cash, additional shares, or other property. Now, why do companies pay dividends? Companies distribute dividends to share profits with their investors, showing confidence in their financial stability. It's also a way to attract and retain investors. For you, as an investor, dividends provide a steady income stream without having to sell your shares. It's a win-win. For instance, you own 100 shares of a company that pays an annual dividend of $2 per share. That means you'd earn $200 in dividends each year just for holding those shares. And here's the best part. If the company does well and increases its dividend, your income goes up too. Now that you have a grasp of what dividends are and how they work, it's time to set up your financial goals. The first step towards earning $5,000 a month in dividends is determining how much you need to invest. Start by calculating your monthly income needs. For our goal, we're aiming for $5,000 per month, which translates to $60,000 per year. But how much do you need to invest to achieve this? The answer depends on the dividend yield of your investments. The dividend yield is a percentage that indicates how much a company pays in dividends relative to its stock price. For instance, if a stock is priced at $100 and pays an annual dividend of $5, its yield is 5%. To find out how much you need to invest, use this formula. Investment required equals annual income desired divided by dividend yield. Let's say you aim for an average dividend yield of 4%. To generate $60,000 annually, you need to invest $1.5 million. $60,000 divided by 0.04. This might seem like a daunting amount, but don't worry. We'll break down strategies to reach this target more effectively. Start by assessing your current financial situation. Take a look at your savings, investments, and any other assets. How much can you allocate towards dividend investing? Remember, every bit helps. Next, set a timeline. How soon do you want to reach your goal? If you're starting from scratch, it might take several years. However, with a disciplined approach, consistent investing, and the power of compounding, you can make significant strides. Finally, keep in mind that investing is a long-term game. Market fluctuations are normal, and it's essential to stay focused on your goals. Regularly review and adjust your portfolio to stay on track. Achieving $5,000 a month in dividend income is an exciting goal, but it's important to be aware of some caveats that could impact your journey. Let's discuss the key factors you need to consider to make informed decisions and set realistic expectations. First, let's talk about the amount of money needed. As we discussed earlier, to generate $5,000 a month or $60,000 a year in dividends with a 4% yield, you need to invest $1.5 million. This figure can seem daunting, especially if you're just starting out. Realistic expectations and timelines are crucial. Dividend investing is not a get-rich-quick scheme. It requires a long-term perspective. The market can be volatile, and dividend payment can fluctuate. Companies may reduce or eliminate dividends due to economic downturns or internal challenges. This is why it's important to diversify your investments across various sectors and companies to mitigate risks. Don't rely on a single stock or sector for your entire income. Now, let's discuss an American's net worth at every age. Understanding this can give you a realistic benchmark and help you set achievable goals. According to recent data, the median net worth for individuals in their 30s is around $76,000. For those in their 40s, it's approximately $144,000. In their 50s, the median net worth is about $177,000. and for those in their 60s, it's around $187,000. These stats clearly show that an average American does not have around $1.5 million to live completely off dividends. Now that we've discussed the caveats to reaching your $5,000 a month dividend goal, let's explore strategies to overcome these challenges. The key to success lies in leveraging time and effective investment strategies like the dividend reinvestment plan, or DRIP, the snowball effect, and consistent monthly contributions. First, let's dive into the dividend reinvestment plan, or DRIP. DRIP is a program that allows you to automatically reinvest your cash dividends to purchase additional shares of the stock. This reinvestment happens without any transaction fees, making it a cost-effective way to grow your holdings. By consistently reinvesting your dividends, you increase the number of shares you own, which in turn generates more dividends. It's a virtuous cycle that accelerates the growth of your investment. The snowball strategy is closely related to DRIP and involves reinvesting dividends to compound your returns over time. The idea is to let your dividends buy more shares, which then generates more dividends, and so on. This strategy works best when combined with regular, disciplined investing. For example, if you set up automatic contributions to your investment account, you can steadily build your portfolio without having to think about it. This approach minimizes the impact of market volatility and keeps you on track toward your financial goals. Another powerful strategy is making consistent monthly contributions. By contributing a fixed amount to your investment portfolio every month, you can take advantage of dollar cost averaging. This means you can buy more shares when prices are low and fewer when prices are high, which can lower your average cost per share over time. Regular contributions help smooth out the effects of market volatility and keep your investment plan on track. For example, let's say you contribute $500 every month to a portfolio with a 4% dividend yield. Over a year, you would invest $6,000, plus the dividends generated by your growing number of shares. This regular investment boosts your portfolio's growth and brings you closer to your $5,000 a month dividend goal. In the end, I will show you a portfolio of stocks that, when combined with these strategies, can cut the 30-year time frame by almost half and help you reach the $5,000 monthly dividend income goal. The combination of DRIP and monthly contributions creates a powerful synergy. Reinvesting dividends accelerates your portfolio's growth, while regular contributions ensure steady progress toward your financial goals. This approach requires discipline and commitment, but the long-term benefits are substantial. Now that we've discussed strategies to overcome the caveats, let's dive into choosing the right stocks to build a robust and profitable dividend portfolio. Picking the right stocks is crucial for ensuring a steady stream of dividend income and achieving your financial goals. When selecting dividend-paying stocks, consider the following criteria. Dividend yield, which is the annual dividend payment divided by the stock price. A higher yield can indicate more attractive income, but extremely high yields can be unsustainable. Look for companies with a history of consistent dividend growth, as this shows a commitment to returning profits to shareholders and confidence in future earnings. The payout ratio, or the percentage of earnings paid out as dividends, should be lower to indicate enough retained earnings for growth. Additionally, analyze the company's financial health to ensure it has a strong balance sheet, stable earnings, and manageable debt levels. Finally, focus on companies that are leaders in their industries or have a competitive advantage, as they are better positioned to weather economic downturns and continue paying dividends. Here are a few examples of stocks known for their reliable dividends. CTO Realty Group is a real estate company specializing in income-generating properties with a strong history of dividend payments, offering investors steady income through its diversified portfolio. ProShares S&P 500 Dividend Aristocrats ETF focuses on companies with a strong track record of increasing dividends, providing stability and steady growth for dividend investors. American Tower Corporation is a leading REIT specializing in wireless and broadcast communications infrastructure, known for its consistent dividend growth and strong financials, making it a solid choice for income-focused investors. Extra Space Storage is an REIT specializing in self-storage properties, offering reliable dividends and a strong history of dividend growth, making it popular among investors. Broadcom is a technology company with a high dividend yield, provides investors with both strong financial performance and consistent dividend payments. When combining these stocks into a single portfolio, the overall metrics are compelling. This portfolio is strong for several reasons. First, with an average yield of 3.65%, it provides a solid income stream, essential for investors seeking regular cash flow. The impressive average dividend growth rate of 18.73% ensures that the income from dividends is not only reliable, but also increasing significantly over time. protecting against inflation and enhancing future income potential. Additionally, the average share price appreciation of 13.50% demonstrates the potential for capital gains, adding another layer of value to the portfolio. The inclusion of stocks from different sectors, real estate, technology, consumer goods, and communications, spreads risk and increases the stability of the portfolio. Finally, the portfolio balances high-yield, stable dividend payers with high-growth stocks, ensuring a mix of immediate income and long-term growth. Understanding the future projections of a dividend portfolio is essential for setting realistic expectations and planning long-term financial goals. Here, we analyze two scenarios, one without using dividend reinvestment and monthly contribution strategy, and one with both, highlighting the impact of disciplined investing and the power of compounding over time. In the first scenario, the portfolio starts with an initial investment of $10,000 without reinvesting dividends or making any further contributions. With a portfolio metrics, the investment grows to $11,350 after 1 year. After 10 years, it reaches $35,478, reflecting steady growth despite no additional contributions. After 20 years, the portfolio increases to $125,869, and by 30 years, it reaches $446,556. At this point, the annual dividends amount to $62,983, providing monthly dividends of $5,249. Over the 30 years, the total value added is $821,711, including capital appreciation of $436,556 and total dividends of $385,155. Even though this achieved the goal of a $5,000 per month dividend income, you can reach it significantly faster if you implement the two most important dividend strategies. In the second, more proactive scenario, the portfolio starts with the same initial investment of $10,000 but includes an annual contribution of $6,000 or $5,000 per month. With all dividends reinvested to leverage the power of compounding, after 1 year, the portfolio grows to $17,715. After 10 years, the value increases dramatically to $197,468. And after 17 years, this portfolio will be valued at $813,375. And from this point onward, paying an annual dividend of $54,718, translating to about $4,560. That is closer to the $5,000 target goal. If you wait for the 20-year mark, after 20 years, the portfolio has the potential to reach an impressive $1,522,938, paying $118,468 in annual dividends, or a monthly income of $9,872. This scenario highlights the immense power of dividend reinvestment and regular contributions. The portfolio not only grows significantly larger but also generates a much higher income stream. The reinvestment of dividends accelerates the compounding effect, leading to exponential growth in both portfolio value and dividend income. The comparison between the two scenarios clearly show the benefits of a disciplined investment strategy. By reinvesting dividends and making regular contributions, investors can dramatically enhance their portfolio's growth and income potential, and ultimately reach the target goal of $5,000 the fastest way possible, while still being on the safer side. With any income comes the tax from Uncle Sam. Click the video on the screen to fully optimize your strategy and receive a consistent monthly income.